In 2008, the American housing market collapsed and millions of families watched their life savings disappear almost overnight. Entire neighborhoods were filled with foreclosure signs. Banks failed, financial markets crashed, the shock spread across the global economy. And now in 2026, a new question is quietly rising across the United States. Is America heading toward another housing market crash? For the past few years, home prices across many American cities climbed at historic speed. Low interest rates, pandemic stimulus, remote work migration, and limited housing supply pushed prices to record highs. Buyers rushed into bidding wars, properties sold within days, sometimes within hours. For many Americans, owning a home once again felt like a dream slipping out of reach. But economic conditions have changed dramatically. Mortgage rates are no longer near historic lows. The Federal Reserve increased interest rates aggressively to fight inflation, and those higher rates have transformed the housing market. Monthly mortgage payments are significantly higher than they were just a few years ago. Even if home prices stay flat, affordability has worsened sharply. A house that once required a manageable monthly payment now demands hundreds or even thousands of dollars more each month for the same property. This shift alone has pushed many first-time buyers out of the market. Demand has cooled in several regions. Listings are sitting longer. Price reductions are becoming more common. In some overheated cities, early signs of price corrections are already visible. Markets that experienced extreme growth during the remote work boom are now facing slower demand. Tech-heavy regions, where layoffs are increasing, may see additional pressure. If employment weakens, housing demand usually follows. At the same time, supply remains tight in certain areas. Homeowners who locked in low mortgage rates years ago are reluctant to sell. They do not want to replace a low rate with a much higher one. This creates a unique market imbalance. Fewer buyers due to high rates, but also fewer sellers due to rate lock. In real estate, experts are divided. Some argue this is a healthy correction, not a crash. They point to stronger lending standards compared to 2008. Banks today require higher credit scores, more income verification, stricter underwriting rules. Adjustable rate subprime mortgages are far less common than during the previous bubble. Others warn that risk may be building in different areas. Commercial real estate is under severe pressure. Office buildings in major cities remain partially empty due to remote work trends. Property owners with large loans are facing refinancing challenges and much higher interest rates if commercial defaults increase. Financial institutions could feel stress. Regional banks in particular have significant exposure to commercial property loans. If property values fall sharply and borrowers cannot refinance at affordable rates, bank balance sheets may weaken. Financial markets are watching closely. Housing affordability is now one of the biggest concerns for middle-class families. Even those who purchased homes at peak prices may feel pressure if property values decline. Equity can disappear quickly if prices correct significantly. While many homeowners still have strong equity buffers, the speed of price growth in recent years raises questions about sustainability. Construction activity has also slowed in certain regions. Builders face higher material costs, higher financing costs, and uncertain demand. Some projects are being delayed. If new construction drops too sharply, it could limit future supply, but in the short term, construction job growth may weaken. Another factor influencing the 2026 housing outlook is demographic demand. Millennials remain a large group entering prime home buying age. Long-term structural demand exists. However, affordability barriers may delay purchases, pushing more families into the rental market. The rental market itself experienced rapid price increases in recent years. Now in some cities, rents are stabilizing or even declining slightly due to increased apartment construction. Investors who purchased rental properties at peak valuations may face lower returns. If rents soften, global economic uncertainty adds another layer. International investors often view American real estate as a safe asset. But if global growth slows or currency conditions change, foreign investment flows may shift. Comparisons to 2008 are inevitable, but important differences exist. During the previous crisis, risky mortgage products were widespread. Lending standards were extremely loose. Borrowers with weak credit obtained large loans with little documentation. When housing prices began falling, defaults surged rapidly, triggering a financial chain reaction. In 2026, household balance sheets appear stronger. Overall, mortgage holders generally have fixed-rate loans with lower rates. Many refinance during low-rate periods, locking in manageable payments that provides some protection against forced selling, however. Rising credit card debt, auto loan delinquencies, and student loan repayment resumption could strain household budgets. If unemployment increases simultaneously, housing stress could rise. Investor activity in housing also changed over the past decade. Large institutional investors purchased single-family homes in certain markets, converting them into rental portfolios. If property values decline sharply, investment funds may reassess strategies. Though large-scale selling could accelerate price drops, most investors aim for long-term holds. The political environment in 2026 adds further complexity. Housing affordability has become a major election issue. Candidates debate zoning reform, tax incentives, rent control policies, and mortgage relief proposals. Public frustration over high housing costs remains strong. Interest rate policy remains central. If inflation continues easing, the Federal Reserve may consider rate cuts. Lower mortgage rates could revive demand quickly, but if inflation resurges, rates could remain elevated, prolonging housing stagnation. Real estate markets are highly local. National averages sometimes hide dramatic regional differences. Some states may experience modest corrections, while others remain relatively stable. Migration patterns influence these shifts. Areas with strong job growth tend to sustain housing demand. Climate risks are also becoming a factor. Insurance premiums in certain coastal or wildfire-prone areas are rising sharply. Some insurers are withdrawing coverage entirely. Higher insurance costs reduce affordability and can pressure property values. Home equity lines of credit are another variable. If homeowners begin tapping equity aggressively during financial stress, risk levels increase. So far, equity withdrawal remains moderate compared to pre-2008 levels. Consumer psychology plays a powerful role. If buyers believe prices will fall further, they delay purchases. That delay reduces demand temporarily, creating self-fulfilling pressure. On the other hand, if buyers believe the market has bottomed, demand can return quickly. Financial markets closely monitor housing indicators, including new home sales, existing home sales, building permits, housing starts, and price indices. Sudden declines across multiple indicators often signal broader economic slowdown. The housing market connects deeply with the banking system, construction industry, manufacturing, employment and retail spending, furniture, appliances, renovations, and landscaping businesses all depend on housing stability. A full-scale housing crash would not only affect homeowners, it would ripple across employment, credit markets, and consumer confidence. That is why analysts are watching every data release carefully. At present, evidence suggests cooling rather than collapse in most regions. But risks remain. If job losses accelerate and mortgage rates stay high, pressure could intensify. The central question remains whether current conditions represent a natural post-boom adjustment or the early stage of a deeper correction. History shows housing cycles often unfold slowly before accelerating unexpectedly. American real estate has long been considered a pillar of wealth building. For many families, home equity represents their largest financial asset. Fear of losing that value creates anxiety. Yet the U.S. economy has demonstrated resilience before. Even after 2008, the housing market eventually recovered, reaching new highs over the following decade. In 2026, uncertainty dominates headlines. Some predict stabilization, others warn of correction. A few fear collapse. The truth likely lies somewhere in between, shaped by interest rates, employment trends, consumer confidence, and policy decisions. For potential buyers, patience and financial discipline are critical. For homeowners, maintaining emergency savings and avoiding excessive leverage remains wise. For investors, diversification matters. The coming months will reveal whether America is heading toward another dramatic real estate collapse or navigating a challenging but manageable transition. The housing market stands at a crossroads, influenced by inflation, monetary policy, global uncertainty, demographic demand, and psychological sentiment. As data continues to emerge, one thing is clear: housing is more than numbers. It represents stability, security, and the American dream, and in 2026, that dream feels uncertain for many. Watching prices, rates, and headlines, wondering what comes next.